Investors will pay close attention to the PCE inflation report due at 8:30 a.m. Eastern Time this morning. Let's talk more about the markets with Kevin Mahn, President and Chief Investment Officer at Hennion Walsh Asset Management. Kevin, first of all, I just want to get your view on the market. This is last, obviously, trading day of August. You've studied this S&P rebound from the fifth worst start to the year to where we are today, back to record highs. How much longer do you think the rally can last?
Yeah, my major question is, where is all the volatility gone? Over the prior 20 weeks, the VIX has declined by 69%, the largest volatility crash on record. We've now had 20 record highs for the S&P 500 this year, following 57 record highs last year. We're trading at a current P of roughly 26, well above their 5- and 10-year averages. So how much longer can we run, and when will volatility return? I think investors should brace themselves for more short-term bouts of volatility, but that doesn't mean they should flee to the sideline, because there's still more growth opportunities ahead if you follow the money in terms of where all the spending is taking place. And where it's taking place, AI infrastructure and aerospace and defense.
So we, as I just mentioned, we get PCE later this morning. How much of the rally do you think are investors looking for different places to park their money that will outrun the potential for inflation, given all of the inflationary uncertainties, whether it pertains to immigration, tariffs, fiscal policy, where rates are headed? Is it, as opposed to other asset classes, they could park their money, stocks, especially growth themes that you mentioned, may have more potential to outrun that.
It matters. And right now, the core PCE estimate is for 2.9% year over year. Remember, this is the Fed's preferred inflation gauge. I think if we're below 3.0, away we go with that first interest rate cut of 25 basis points in September. However, if we get a core PCE year over year number that's 3% or higher, the Fed may be on pause for yet another month. The market isn't expecting that. The market has already baked in a 25 basis point cut for September. So today's reading is very important.
Well, and another one for December. I mean, is that a risk then? Or will it just be a 2% move on the moment that the inflation data comes out? If people start to price out cuts again?
I think it would create a short-term bout of volatility, but there's still so much cash sitting on the sidelines right now waiting to chase these returns that we're seeing in the stock market. I still think they go 2 times this year, one in September, one in December. But of course, I don't have a vote yet. They're not calling me asking for my input. But I think there's 2 rate cuts this year and 2 rate cuts next year.
So just to put a fine point on it, you think today's PCE reading could essentially pour cold water on the September cut notion, regardless of what we see next week for the jobs report for August, which has been so in focus. And I asked that against the backdrop of the speech in Jackson Hole by Fed Chair Jay Powell, where he talked much more about the conditions in the economy and the labor market relative to kind of price stability.
Yeah, I think it could pour some cold water, but I've been in the camp that they should have cut interest rates back in June, when they raised their forecast for unemployment to 4.5% this year, when they lowered their forecasted GDP growth to 1.4% this year. They believe GDP growth is going to stay below 2% for the next 2.5 years. If that's the case, they should have been more accommodative all the way back in June. But they're still concerned with the potential inflationary impact of tariffs, which is why they raised their inflation forecast to 3.1%. I think that's misguided. I think they're more concerned now about the labor market than they are with inflation. And that's why I still think that 25 basis point cut is in the cards for September, unless we get a really hot core PCE number this morning.